Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 26th, and today the market mood is gold is wearing a cape, the dollar is limping, and AI infrastructure is still inhaling money like it's oxygen.
I love days like this. The charts look like they drank 3 espressos and then remembered they left the stove on. Tell me we're not doing everything is fine while gold is literally screaming above $5,000.
Story 1. Gold pushes above $5,000 an ounce in multiple market wrap headlines. The simple takeaway, investors are paying up for insurance, and the bill is getting bigger.
When gold hits $5,000, I assume someone somewhere just printed a scary headline in all caps. Is this inflation fear? War fear? My portfolio needs therapy fear? Or yes?
It's basically like buying a fire extinguisher when your neighbor's grill is already smoking. Gold tends to benefit when uncertainty rises, real yields feel less attractive, or people doubt the stability of the usual store of value options. The key is, gold doesn't pay you, so the price is what you're willing to pay for comfort.
So gold is the emotional support animal of assets. Cute. But for normal people, does this mean groceries get worse, mortgages get worse, or just that rich people are panic ordering vault space?
For households, gold at extremes is more of a signal than a direct cause. It can hint at risk-off sentiment, geopolitical stress, or currency confidence issues. Actionable angle, if your plan relies on nothing ever shocks the market, today's tape is a reminder to diversify and avoid concentrated bets that only work in calm weather.
Don't build your retirement plan on vibes. Also, if gold is the fire extinguisher, some people are clearly using it as a flamethrower because that chart is vertical.
Story 2. The dollar hits a 4-month low while the yen strengthens on speculation about possible coordination or intervention. USD JPY has been a pressure point, and the headlines point to intervention risks becoming part of the market's daily math.
I love how currency markets are like, nothing to see here. Then suddenly, the adults might step in, and everyone spills their coffee. If the yen spikes, who gets bonked first?
Think of FX like the tide under the whole boat. A stronger yen can tighten financial conditions for Japan-linked trades and can force unwind of carry trades, where investors borrow in a low-rate currency and buy higher-yielding assets elsewhere. When that reverses, risk assets can wobble, even if nothing fundamental changed overnight.
So it's like everyone borrowed the cheap umbrella, went to the beach, and then the weather app screamed hurricane. Now they're all sprinting to return the umbrella at the same time.
Exactly. For everyday investors, check your hidden currency exposure. International stock funds, global bond funds, even some commodity plays, FX can amplify or mute returns. If you don't know whether your fund is hedged, today is a good day to read that one boring line in the fact sheet.
The boring line is always the line that moves your money. I hate that you're right. Also, if the dollar's sliding and gold is flying, that's a very mom pick-me-up combination.
Story 3. Reports say CoreWeave stock jumps after Nvidia invests about $2 billion to expand AI data center capacity, with a noted purchase price around $87.20 per share in one item. The finance behind it is a capital loop. Chips drive demand for compute providers raise money to buy more chips, and the ecosystem reinforces itself until a bottleneck hits.
So Nvidia is like, we sell the shovels, and also we'll invest in the gold mine, and also we'll help finance the mine buying more shovels. This is either genius or a very expensive group chat.
It can be rational. If you're the key supplier, you care about downstream capacity because it determines how fast your market grows. But it also concentrates risk. If enterprise AI demand slows or financing conditions tighten, the buildout can turn into excess capacity fast.
And we're building these data centers while the rest of us are like, can my laptop stop sounding like a leaf blower on Zoom? Also, I saw another headline, memory chip shortage lasting through 2027. Are we about to pay luxury prices for basic electronics?
Yes, that's the linked thread. Memory is a critical input for AI servers and also for consumer devices. If a shortage persists through 2027, as one item suggests, it can support higher pricing and shift margins across the supply chain. For consumers, it can mean slower price drops on phones and PCs. For investors, it means watch who has pricing power versus who eats the cost.
So today's vibe is buy insurance, check your currency exposure, and remember the AI boom is also a supply chain story. My actionable takeaway is I'm not rage upgrading my phone this year. I'm emotionally hedging.
Quick recap. Gold above $5,000 signals elevated demand for safety. The dollar's dip and yen's strength raise the odds of FX-driven volatility. And Nvidia's CoreWeave investment highlights how AI infrastructure funding and chip constraints can reinforce each other. If you want more episodes like this, subscribe and leave a comment with what you're watching this week: gold, USD JPY, or AI infrastructure.
And if your portfolio is currently doing interpretive dance, you're not alone. Hit like, share it with a friend who thinks carry trade is a gym exercise, and we'll see you tomorrow.